Okay, we're going to talk about net margin, and here's the formula for net margin. It's simply net income divided by revenue. Sometimes we call this profit margin or even return on sales. Sometimes it's net income could be labeled on your P&L as net profit, uh, earnings, net earnings, regardless of what it's called though. It is the proverbial bottom line of the company, and it's usually found at the bottom of the income statement. We'll look at an example in a moment. An analysis of net margin can help us answer two fundamental questions about any company. First, is the company profitable? And second, is the company becoming more or less profitable over time? So now let's look at our example using Hasbro. This is Hasbro's 2018 year-end income statement. You can find it in their annual report or in the 10K that they file with the SEC. So for Hasbro, it's quite simple. The net earnings are $220 million. We divide that through by net revenue, which is $4.579 billion, and we arrive at a net margin of 4.8%. This means after all operating and non-operating expenses, Hasbro has 4.8 cents of net profit for every dollar of sales. So is that good or bad? As analysts, how do we evaluate that? And now that we know that Hasbro's profit margin is a little bit under 5%, what can we say about the company? So to evaluate net margin, we need to compare Hasbro to its peers in the same line of business. In the left-hand chart here, we can see that in 2018, other toy companies had net margins of over 20%, Spin Master was almost 10%, and Mattel was negative. And on the right-hand side, we can see that Hasbro's net margin has been declining very significantly over time. So in general, we like to see net margins higher than lower and increasing rather than decreasing. And needless to say, net margin should be positive for a healthy company. So when we consider Hasbro in this case, we can say that Hasbro's profitability has been declining over the last several years, and it is currently in the low end of its industry.